Hello everyone and welcome to the second part of the Structured Product Training course with SRP. My name is Tim Mortimer. I'm Managing Director of Future Value Consultants, FVC. So let's get on with the training that I have for you today. This is the second part of the course that SRP and FVC are presenting, and this is all about analysis of structured products. And it has been prepared for the September 2020 conference series that SRP have been producing, covering the Americas, France, and Italy. The contents that I'm going to cover for you now are as follows on the screen. First of all, I'm going to talk about bringing products to market. Then I'm going to summarize different product testing frameworks. Then look in more detail at some of the quantitative aspects, such as stress testing and back testing. And then turn our attention to buy-side and advisor and broker reporting and some considerations on portfolio analysis. The content I'm going to show you today will start with a PowerPoint presentation, go through various slides with the different areas I want to talk about. Then I'm going to go over to some browser applications and show you some interactivity and how these things can work with different analysis tools. We'll also do actually a bit of Excel spreadsheet manipulation, and I'm going to show you some PDF reports. Okay, so the first section today is bringing products to market. So this is an area we did touch upon in the first episode, where I considered how structured products in general come out into the structured product market, and so how issuers and distributors work together in terms of bringing products that they want to bring to their investor base. So this is a very important, complex and highly sort of dynamic process, which calls into play those that work for issuers, distributors, and then downstream to advisors, brokers, and of course, ultimately investors. So the first part of that is really, where is the investor demands that companies are seeing, and what's the product design process? What products are companies going to put together to try and provide solutions to investor demand that they perceive and that they've had feedback about? So in the first part of the training, we looked at a typical timeline of structured product creation and the issuance cycle. So what the process you have to go through. So this basically involves evaluating investor demand, then go through a design and pricing process to arrive at a suitable product. So once demand and product design have been looked at in detail, the actual nuts and bolts of the process before you bring a new product to market involves pricing and hedging. That's a very important part. So that's where the investment bank and the distributor will work together and go through various iterations, typically, to test different products and see if they can be achieved for the asset base, cost base that is appropriate. And generally, you might have an initial idea, try the first solution. It might not be attractive. You might think it doesn't quite position yourself where you want to be, or it may be that the pricing is either too high or too low, and you want to modify the product to keep it at a suitable asset cost and also provide investor with the best outcome. So that can be a little bit iterative, not only because you are looking to get the product exactly right, but also because, of course, during every day and even from one day to the next, pricing conditions change. So you might sort of price it the first day, not quite be happy with it, come back and the same product has changed a bit in pricing. So with a combination of trial and error and seeing what would actually work best for the investor and the fact that market conditions change, this can take a few days. Now, alongside the pricing and hedging process, which we did talk about in more detail in the first part, is the whole concept of product testing. So now this tends to work in parallel and even before some of the pricing process, and it's a key part of issuance. And the whole point of product testing is to make sure that the product that the traders and desk and the structuring desk wants to put together is actually will satisfy regulatory requirements and is what the bank wants to put out from a sort of compliance and due diligence perspective. So not only do you have to make sure that the pricing works, the product is feasible, but product testing is a parallel process to actually make sure that the product is suitable and the right thing for the investor and can be justified. And with regulators right across the world now, this has been increasingly important over the last 10 years or so. So just to kind of illustrate that, here's a little chart here which shows some of the different elements that need to be thought about. So product design, given that plenty of space on the left-hand side, that's the whole process that might happen before you even get as far as pricing, with involving investor feedback and very high-level considerations like what are the aims of the product, what are the asset allocation, what kind of maturity profile, and what is the risk level of the product should be, and also what's the sophistication of the investor base. If it's a relatively sort of low sophisticated base, then you need to have a product that's quite simple. So that is a process that is always ongoing. And of course, when you have one product issued and maybe a similar one a few months later in like a continuous pipeline, then these considerations will be treated from one to the next. Then in sort of more granular, we've got the pricing and product testing streams that are put side by side. So in terms of pricing, what are the market parameters, volatility, credit spreads, interest rates, etc., that affect the pricing? What's the bank appetite for risk? Where does it actually want to price the product compared to perhaps its competitors? And looking at different variations, as I said just now, the iterative process. And then sort of in parallel, you've got the product testing stream. When you start to look at different variations of the product, what are the likely outcomes? Chances of gains, chances of loss, and how big are those gains or losses? And then looking at comparisons of different product types, different variations against each other, the product that was issued last time, and maybe other products that are out in the market. And then need to consider questions of suitability. Is this really the right product for the investor base that it's being put for? So this training course, as I said, is in conjunction with a few conferences that SRP are putting together for September and are broadcasting. So these actually cover the Americas and also France and Italy. So this slide is really just a very sort of brief overview of the regulatory position across the world, which of course is quite different. We expect that. So in the US, you have the two main regulators, the SEC and FINRA. Their approach to regulation, the SEC in particular, is all about disclosure. Providers have to state every different consideration of the product and what kind of can happen. And the SEC tends to work almost in arrears. It waits to see something it doesn't like and then acts to enforce against that. FINRA, which is the sort of like the second regulator, is a bit more proactive and has had a series of notices and rules over many years, which will touch the different themes for structured products and, of course, other investments. Canada is a much smaller market and also dominated actually by the local issuers, the main big four Canadian banks and some others. It has a little bit of similarities with Europe. It doesn't take quite the sort of direct approach that the US regulators look for. And then if you sort of move across to Europe, as well as disclosure is important, but Europe, the regulation there is really about investor protection front and center. US is catching up a little bit, but PRIPS and MiFID II, which are the two big regulatory directives that came in the start of 2018, very detailed and demanding regimes, both apply significantly to structured products, both affect product testing. The UK is currently following EU rules as it's in the transition period. The FCA, the UK regulator, also brought out detailed stress testing requirements in 2015, which are kind of a forerunner of what PRIPS and MiFID II are doing, and they're still in place. And those principles are also being adopted elsewhere. And then Asia, which is kind of outside the scope of today's presentation, different approaches, obviously many different countries and markets there. But regulation there, as globally, is kind of increasing and is more detailed. And it's also true to say that in the last 10 years, regulators have worked together and observed each other. And you do see some convergence of the way different regulators in different markets work. it's certainly true that they're all looking to increase the way that they apply their rules and the details of those. So if we talk, first of all, in a sort of high level about product testing frameworks, so this is the process which goes alongside the pricing process, as I said. So pricing for traders and structures, that's been around, kind of by definition, as long as structured products have been around, so 20, 30 years. So systems and methods and models and products, may change over time, but the basic process is well known. Product testing is more recent. The FCA stress testing in 2015, 5 years ago, was probably the biggest and the first significant piece of legislation regulation there. And then PRIPS and MiFID II in 2018. The US has had similar sort of rules going back a bit further, but they've been a much lighter touch. So product testing is really a concept that's been around for about 5 years, and I personally see that as only increasing going forward. So the first thing that you need to do is actually higher up than the sort of product testing is setting up a proper governance process. This will apply to an issuer and distributor. So you need to understand the regulatory requirements and follow your own internal compliance rules as they apply to asset classes outside structured products. And you need to create a clear path, which is well documented, different groups or committed to different responsibilities, to incorporate all aspects of product design, product testing, investor feedback, and also internally evaluating how your pipeline is working. So that's the first thing that needs to be done. And that needs to be put in place properly and maintained and updated perhaps on an annual basis. So drilling down a bit further more to the sort of scope of this presentation, we then think about quantitative product testing. So given that you want to analyze products that come out to market, and given the way structured products are with their variety and detail in the product type, a quantitative approach is clearly necessary. So generally, regulators require a consistent regime, and companies look to do that. So they choose their regime first, how they want to test products, and they generally want to do that the same analysis and the same process for each product they put out, both from one month to the next, and also whether something is relatively high risk or lower risk, and even for which investor base it's coming out to. So in general, you need a robust automated framework to make that work. If you're going to do a consistent, apply a consistent testing regime in a timely fashion for particularly a large volume of business, as many banks and distributors will have, it's got to be automated so that you can analyze products reliably and quickly. And then, having done the analysis, the final piece, which is arguably the most important, is how you're going to consume those results. How are you effectively going to decide which products are good and suitable to put out to market and which aren't, which effectively comes down to a pass or fail. I mean, ultimately, having done some testing, you either bring the product to market or you don't. In terms of the testing results, you could sort of put those into 3 categories: clear pass, clear fail, maybe refer to a sort of committee if it's borderline, or if it's a new product type, or if there's something else special about it. So the feedback process, having set these things up and got them working, is obviously very important. Make sure that it's fit for purpose. Always evaluating how your pipeline is working. Understand particularly investor experiences once products mature, or perhaps during their lifetime. What do investors think about what's being put out? And learn from previous issues and implement improvements. So stress testing is the sort of first pillar that we'll talk about in terms of product testing. Is actually the most important one. So definition of stress testing, which was, like I said, first actually sort of created by the UK's regulator, the FCA. That is really a way to do simulations and evaluations of a product before it's been traded and certainly before it started. So most regulators now prefer simulations and risk measurement as the key part of stress testing. Back testing, which we're going to talk about in a minute, plays a lesser role. So in terms of stress testing, typically parties now like to use historical data to generate sample paths and provide the engine for the simulations, the Monte Carlo. Historical data is preferred over implied data because historical data is available to all parties, particularly on the buy side. Implied data, which is how pricing is done, is something which is really only accessible to banks, and also each bank has a different view of the world in terms of its pricing. So historical data is simpler to set up, and it also allows all parties to have a similar answer, which is good for the market with sort of consistency there. And so by historical data, what we mean is take an underlying, perhaps measure its 5-year volatility, its estimated dividend yield, and then use that to generate new simulations to test a product. So what we're going to do is we're going to simulate the underlying asset. Each product has its own payoff, and then given the distribution of the underlying asset and the payoff of the product itself, you're then again going to get a simulation of different outcomes, good outcomes and bad outcomes. So having done a simulation, it's all about measuring those outcomes in different ways. And that's typically done by a report that's got different figures and statistics that measures things like risk profile, probability of capital loss, probability of beating cash. And this should be done in a consistent way. This is all part of the pipeline operation at the beginning. While stress testing as a sort of generic concept is used in different ways in many countries, we should also mention the PRIPS regime in Europe, which has been around for a couple of years, like I said. That requires a detailed quantitative key investor document, KID, which carries results similar to a stress test. And it's important for companies to do those calculations accurately, and they are effectively something that's related to stress testing. So when it comes to consuming results, I'll show an example of how a stress test report might look like later. But consuming those results is important. So generally you keep the full report, but ultimately, as I said, you want to decide whether something is going to pass or fail. So you also need to decide which of those statistics will form the basis of that evaluation. And it's generally simple things like return of capital, risk level, or what's called a value for money test, which we'll talk about later. So here I have a sample stress test report. This example has been provided by the system that we provide at our firm, and happily go through that in detail a bit later to give an idea of how stress testing can be done. So the middle screen is how the interface looks, and the report that we produce. There's a couple of charts you can see there, which will just give a flavour of what the product payoff might look like, which is quite good as a first check. And then there's some snippets of how some of the report figures look like, which I'll go through in more detail. So now I'm going to move on to back testing. So back testing is a subject of which I'm sure many of you are familiar with. It's been around longer than stress testing. And the difference with back testing is it's all about looking at how a product would have performed given actual previous historical performance of the underlying. So it has been around for a long time, and you do see in different markets companies providing back testing results, perhaps in marketing information or investor information. And so they are backward looking, but they're quite easy to interpret. So the basic method is as follows. Let's suppose I have a product linked to the S&P that's 2 years long, an autocall with certain parameters. So I can say, right, I can go back as far as I like, 5, 10 or 15 years, and say I can measure the S&P on a 2-year horizon if it's a 2-year product, pick a date going far back in the past, and then say, right, that's my start level, look forward 2 years in the future and any other dates that matter in the meantime, what would that product have paid off? So this is starting perhaps in 1990. Between 1990 and 1992, if that same product was available, what would it have paid off? And then I can actually just go 1 day forward and measure over the next 2-year window the likely outcomes and move that window all the way through until as far as I can go So if it's a 2-year product, we're now in 2020, you have something that's starting in 2018. So you can measure the outcomes in different ways using realized historical results. And so this is actually a great favorite of product providers in marketing literature. So it's easy to interpret the results. If the product had existed in the past, this is what it would have performed. That's its kind of plus point. There are various pitfalls. How far back do you go? Is it valid to assume the same product would have been available in the past? It almost certainly wouldn't have been, but how much of a drawback can that be? Regulators, it has to be said, do have a bit of a distrust of backtesting because, first of all, the past is no guide to the future, as the phrase goes, but also because which window do you take, and also temptation of what you could call product fitting. So because you can quickly evaluate what the backtest results will be, you don't want a process which overly relies on the backtest, because it is possible to construct products which have great backtesting but don't necessarily have good forward-looking prospects, which is why stress testing has taken over in regulatory terms, because stress testing will generally flush out the dangers and the risk. Backtesting will just show you what has happened, and that may or may not be the same thing. So in product testing today, backtesting alone does not really play a significant role. However, as a comparison, it's always good to look at it against the simulation results, understand why they're different. So certainly prior to this year, it's true to say that equity markets have been on a fairly decent upward trend since the financial crisis in 2008. So most backtesting results tend to look more favorable than simulations. Obviously, 2020 has brought its own challenges, and that's not quite the same in this year, but you can get a bit of a disconnect. However, I guess what you could say is that poor backtesting outcomes, could be construed as a bit of a red flag, either commercially, because you don't want to show that from a marketing perspective, or even from compliance. If you're putting out a product which has definitely performed badly in the past, then that's probably not a great idea. So stress testing and back testing is really things which concern the issuers and distributors before they bring products to market. If we now sort of jump a bit further ahead in the process, where we're about to bring a product to market, you can consider moving downstream. So any channel which uses advisors or brokers, be they independent or even actually part of a network, it's quite important to bring some of that information down to for advisors to be able to use to put in front of their investors. And if you're actually in an environment where it goes direct to investors, then the investors would do the same thing. So advisor reporting is a little bit different, but applies some of the same concepts. So first of all, advisor reporting will generally, you'll get to see that after the product has actually come to market, so you haven't got the iterative process. And also, it's generally more appropriate to have slightly simplified reporting. It's very important for the issuer and distributor to get things right before they issue their product. Advisors obviously are looking at products as one as many different products that are out there, and indeed against different asset classes. So independent analysis is very important at the advisor level, again, in my opinion, and this is something which I can show an example of later. So independent analysis has been very widely used in the fund sector. There's several well-known companies been providing simple fact sheets on different funds for many years, 30 years or more. Whereas with structured products, this was something that took a little while to catch up. So these fund sector vendors provide information on things like asset allocation, performance, and risk data. So because structured products are have more features than straight funds, which are just basically investments that can either go up or down over time, then you have to be think a bit more carefully about what's appropriate to report, both to give the different features of a product and also to be as consistent as possible with the fund framework. And then how are you providing this analysis? Are you doing it whole of market, which means that you provide the same analysis across different providers, or is it something that's going on a platform which may be a restricted set of providers? So given that out in the marketplace we already have distributor fact sheets, the kind of marketing and investor information I talked about, with certain amount of analysis. And now we have the regulatory documents, particularly the PRIIPs KID in Europe, requiring certain calculations to be done. Then for advisory reporting and independent analysis to add some value, it's got to provide something that those two don't do that. So standardization and independence is very important. And also it can provide a bit more flexibility in regulatory documents. It takes a long while for regulation to get drafted, agreed, and actually go live. PRIIPs, for example, being one of those that took many years to get out there. Whereas it's possible for companies to provide perhaps more nimbly and in more detail advisory reporting, which provides extra information that neither the fact sheets nor the regulatory documents will show you. So this is an example of what an advisor-facing report might look like. So in the middle, you have the sort of the basic terms, and then there's some tables and charts. And I'll show this in more detail on the applications after this presentation. And you can already see that this looks very similar to a fund report that you might see that has been very common in the fund industry for many years. The final thing that I'm going to talk about today in terms of quantitative analysis is portfolio analysis. So with structured products, obviously a lot of attention has been focused on how individual products price. That's what the issuing bank needs to get right. How do individual products, what's their risk profile and what their likely outcomes? That's what the regulators are asking. That's what stress testing is all about. But the next thing to consider is how does a structured product fit in a portfolio? So again, if we draw an analogy to the funds world, if you're considering a new fund for your investor, then yes, you need to look at its past performance. Yes, you need to look at its risk level, its volatility, its drawdown. But ultimately, you're also going to put that into a portfolio. Your investor will have existing investments, and you need to analyze not only its own characteristics, but also what it will do to the portfolio. So analyzing a fund or a structured product on its own is kind of easier. It's one-dimensional, doesn't involve any other moving parts or assumptions. But ultimately, analyzing it within a portfolio is just as or even more important, because that's what the investor has. They have portfolio A without the product, portfolio B after the product. How has that changed the risk profile and other characteristics? So structured products, the analysis has very much been about looking at products one at a time, which is logical and kind of easier. But given that structured products go to investors who generally have a portfolio, let's say, of cash, funds and bonds, then when you add that structured product in, you are changing that profile. So although it is quite tricky, particularly for structured products, for a number of sort of technical reasons, it is very important in order to take assessment and opportunity to the next level. And in the UK, for example, the Trade Association, the UK Structured Product Association, brought out this year an application to analyse structured products in a portfolio, and our firm built and powered this application, and we'll be delighted to show an example of how to consider structured products in a portfolio. This is something that has reached other markets globally, not all of them yet, but it's something that I see as an increasing trend. And this is how a portfolio analysis report might look. So red and blue lines indicate performance with and without structured products in the portfolio. And then you also see, I guess, a crossover between what you'd expect to see for a fund or structured products on its own, and also portfolio considerations, particularly on a historical basis. Right, so that's the main PowerPoint part of the presentation over for today. I'm now going to show some examples of actually doing analysis So here I have a portal, the stress testing portal that our firm provides. Obviously, there's other solutions out in the market for different regimes, but I want to give a flavour of how stress testing in general might work. So typically, you have either a web-based portal or perhaps a more automated solution with APIs for doing calculations in high volume. But ultimately, it's all about testing products one at a time and looking at their characteristics before a product comes to market. So the one that I want to look at is an example which we're going to consider in the Excel a bit later, actually. So this is a typical screen of how you set a product up. So, and this is not a million miles away from how a bank would set it up on its trading systems. And typically, when banks work with external vendors, they're able to map their definitions with a external definition. So we can quickly run through the definition. It's all kind of quite easy to understand. So we've got a 2-year product, 2020-2022, defines the issuer and the currency, and then we've selected 2 underlyings, which is the NASDAQ and the S&P, 2 well-known US indices. And this product, as you can kind of guess from the inputs, has got potential autocall amount of 10% per annum with a quarterly frequency, first call date on the 2nd quarter, so that's 6 months, and then a schedule like this. So after 6 months, because it's 10% per annum, if you call successfully, you're getting 105, and then add 2.5 per quarter with the final call point paying you 120. And then the downside is 70 European barrier with a gearing of 1. So this product is 2 years long. Every quarter, starting from the 2nd quarter, 6 months, if both indices are above the autocall level of 100, the starting level, then the product will call, and it will pay 2.5% for every quarter it's been in operation. This is a worst off, as we can see here. So this is the product which I'm going to be talking about a little bit today. In terms of its analysis, so this is already run on our system, and so most vendor systems run real time, just like a trading desk would do for its own pricing. And so this is the result of the test. So because this is supposed to be part of a compliance framework, the report should be very much standalone. So it has a sort of intro page, the definition of what's going to be analysed, and this is something which is typical of the way people analyse structured products out in the market. Then there will be some definition of the product terms. And confirmation of market data. So what assumptions have been used for the stress test? This is the historical based assumptions I talked about earlier: volatility, dividend yields, interest rates, and then correlation assumptions. While it doesn't form a key part of the report in terms of any decisions, it's always good to have some charts. So here we can see different combinations. So if the indices go down, you're losing money. If they perform below par but not the barrier, you're getting 100 back. And then these dots represent calling at different times. And then you've got distributions of outcomes, either annualized basis, negative, 0 and positive, or on an absolute return. 100 is getting your money back. These two above 100, these ones are below 100. So obviously I won't go through in detail what this was all about, but just give you a flavor. So this is a very typical figure that people will look at in however they're doing their testing. So simple tests such as, does the product lose capital, return exactly capital, or beat a deposit, so a kind of hypothetical cash account. And then you can ask similar questions in terms of the underlying assets as well. It's also typical in stress testing to define different scenarios. So neutral is something where there's a sort of expectation the market will go sideways more or less, but can go up or down with the volatility. Bull and bear is the names that are sometimes used for more favorable growth rates or less favorable growth rates. So, for example, here we have under the neutral, the chance of beating deposit 67%. Under bull, it's 77. It's higher because there's more favorable market conditions, and under the bear, it's less. It's 58. So that table is very generic. You could apply that table for any product type. And then the other thing that's also quite important is something which is more granular by product type, because this is an auto call with different call points. This shows you probabilities of calling at different times and the payoff and the time it takes to come back. And you can also do that on a back-tested basis as well. So while I said that back testing is not a key part of product testing, which is true, it's kind of natural to look at it as well. And from a marketing and fact sheet perspective, you probably want to have an independent source of what's going on. Okay, so there's other figures which people typically look at. One quite important one, which is popular in the UK, is this idea of value for money test, which sets a hurdle rate appropriate to the risk level of the product and says what's the chance the structured product beats that hurdle. And generally it's taken that if it's more than 50% across most of these 6 numbers, then that's a good outcome. And as you can see, these are all comfortably above 50%. So it would pass this value for money test. Okay, so also as part of stress testing and back testing, I'm now going to show an Excel spreadsheet. So I'll give my contact details at the end, and anyone that's interested in seeing more detail, please drop me an email or get in touch. I'll be happy to send across copies of the documents and also this spreadsheet. So this is just a simple Excel example. I'm sure many of you have looked at this. As we've already demonstrated from the results that came out of the system, obviously if you're doing testing and back testing in high volume, you want to have it automated. But just so you can see the results for your own eyes, or to experiment, or perhaps for something on the fly or a new product type, Excel skills are always useful, even in today's world. So I'm going to give an idea of how you might set this up. So I've picked 4 sample underlyings, so they're completely random. Here's the data. So the first, these are 1 and 2, performing very strongly over a 7-year time horizon. 3 and 4, not quite so good. And you can see they kind of go up or down. And it's actually roughly what's happened in the last few years. So if you notice here, I've got 7 years of data. So I'm starting at 2013, going down to 2020. And the reason I've chosen 7 years is I'm picking the same 2-year product as I had just now. And I want to analyze that over 5 years of completed cycles, which is the typical way to do it. So I need 7 years of data because I need to go back 7 years ago and run for the first 2 years, which takes me from 7 years ago to 5 years ago, and then step through. And the last point I can go to is 2 years ago, finishing yesterday. So I'll need 7 years of data to provide 5 years of full cycles, which is usually how it's done. And I've just rebased all these underlyings to 100. And then the point of this little lookup, I was going to show you a couple of examples quickly. So let's select number 1 and number 2, which are the 2 favorable. And then for those that are interested, just to see how this is done. So I've deliberately made this kind of quite detailed so that you can see exactly what's going on. Like I said, this is not really how people do things in production, but it gives you a flavor. So here's my 7 years of data, 2013 to 2020. This next column, where I'm going to start my back test from, will only go through 5 years, 2013 to 2018, because these are my start dates. If you consider I have here 1,200 different start dates from 2013 to 2018, that's so I'm going to run the back test for all of those individually. And then because this is a 2-year product with quarterly observations, the 8 dates are the only ones I need to know. And so I've set up this for 8 quarters. So the first one, 19th of August 2013, this is time 0 to start. And then the first quarter is 3 months later, etc., etc. And the 8th quarter, 2 years later, 19th of August 2015. And then the next one is the 20th, so it moves forward one day, and then the one at the very bottom starts at 2018 and finishes very recently, 2020. Okay, so those are my dates that I need, and I'm kind of lining up 1,200 candidates to do that. And then the next thing I need to do is to, with a VLOOKUP, one of the best functions in Excel, is to extract the asset values. So because this product is a worst of two indexes, I need to measure them both. So I won't go through in detail how this works, but it's basically taking the value from my first data series over here. I know what date I'm after. This is my original data. So this thing here just pulls out where the data, what data values I need. So it starts at 100. 3 months later, it's at 108. Another 3 months later at 111, etc. And then the second row is the second candidate, which starts a day later. So its value is quite close to 100. And then its next point is 3 months after the 1 day later point. So equally, that's kind of quite close to this one. And then you go through every candidate. You need to go through and find the start and the 8 quarter points. And then you continue that process all the way down. And the VLOOKUP, you can copy and paste. Those of you that love your Excel with the fairly simple sort of dollaring so that you fix columns or rows or whole cells, you can generate this. Once I got this working, I was able to set up the whole spreadsheet within about 5 minutes. Okay, so we've now measured asset 1. We do the same thing for asset 2. So I'm doing my VLOOKUP from second guy over here, pulling out the second column. I've actually achieved this by a fairly rudimentary thing of this first row is all 1, telling me to pull out asset 1, and then the second row, the second set is pulling out asset 2, and then the row below that goes through quarters 0 to 8. So I've done exactly the same thing for asset 2. So we can see that while they both start at 100 in my example, this is 108, this is 110, so they're different data series. Next thing I need to go through is this product is a worst of, WO. I need to go and work out the relative behavior. So when I'm looking at 1 quarter into a product, I say for each index, how has the underlying gone from its start point to the 1 quarter point? Measure that ratio. So if it's up, it's more than 1. If it's down, it's less than 1. And then look at the other asset. And because it's a worst of, and the worst of will govern both the auto call and the final payoff, I need to take the minimum. So you can see what's going on here. I've got AA7 and Z7, which is slightly out of sight for the first asset, the ratio, and then I'm taking this one for asset 2, 1 quarter divided by its start point, and then take the lower. So this number here tells me that the worst of the 2 assets after 1 quarter on a relative basis was 1.086. So the worst one was up 8.6%. And then I do exactly the same thing. So if we go to here, you can see it's taking second over 0, which is correct. If I go down to this one, it's taking the second row first over 0, also correct. So again, with simple dollaring, you can achieve that result. So these next columns for each candidate going down tell me my worst of performance every quarter. So these 8 numbers are my key values. So I can actually, at this point, for every candidate, I don't need any of the data. Now I've got all the data I need to do the product payoff calculation. And so another kind of quick and dirty word which I like, which is good to visualize. So we need to work out when we call. And we're only allowing ourselves to call at the second point. And we know that the call level is 100%, so both indices have to be up. And also you can only call once. So the way that I like to do that is as follows. So set up this column of zeros, because before I started I haven't called. And then at each of these 8 points, I have this condition here, which I won't go into in full detail, but it's basically checking multiple conditions. Is the relative level of the index above the level? So 1.08 is actually above 100%. is the time of the call point greater or equal to the first call point, which is not the case here because this is the first point and we have to start, only allowed to start at the second call. And also, crucially, easy to forget, I need to make sure that the value before was 0. In other words, I haven't already called. If you didn't put that in, you would kind of think that you were calling multiple times. Obviously, can't happen. So those 3 conditions all have to hold true. And if that is the case, what I'm going to do is to record the number of the time at which I call. So this one here, the lower value is at 1.11, so that's above 100, that's fine. We're now also at the second point, which is the point we can actually call, so it satisfies that condition, and we haven't called before. So, so you notice this has a 2 in here, which tells me that I've actually called at time 2. And then this one here, it's still above 100, but it's already called, so we don't replace a 2 with a 3. Keeps it as a 2. So following that first row through, we can go through to see that we called, time we get to the end, we called at point 2, which is correct. If calling doesn't occur, then you need to measure the final outcome, which is, because it's a barrier of 70%, if the index or the worst of index finishes above 100, above 70, you'll get your full capital. Below 70, you get the value of the lower index. And you might as well work out the final value anyway, because we'll just choose not to use it. So you can see I've got the final value going on here. And so for the 70, because of the relatively favorable underlying, which is actually quite typical of recent back testing, they've all passed. And the payoff we can work out by knowing when we called or if we didn't call the payoff. So this is the actual payoff of the product. So I've taken all the data, worked out whether I called or not. If I didn't call, work out my payoff. And this is actually the payoff of the product. So let's stick that in yellow because it's a very important column. So this is the product payoff, and here we can see the date, the payoff, the term. So this one lasted half a year, and so the annualized return, if I'm getting 5% plus my capital in half a year, that annualizes to just over 10%. And then we go and aggregate and collect up some results. So, so the key I have here is 1 to 8 is calling at those different points. 0 is my key for no call, but with capital return. And -1 is no call and a capital loss. So if we look here and ignore these div zeros because they're just things that couldn't happen. So there were a total of 1,255 of my time points that I could go through, and 998 of them called at the second point, which is actually the first opportunity, and that represents 79.5%. And then when I do a simple sum if, I can then here work out the average return. Now, as it's an auto call, if it is calling here, it's got to be 105. So that's actually quite a trivial calculation, but for other product types, that wouldn't be the case. And then I've got 119, which is 9%, which called at the third point, paying 107.5. And also here, I was able to work out that the min payoff is 1.05, the average 1.06, and the max is 1.175. And these are the min and max terms, and these are the annualized as well. So quite easy. These results on the back testing that I showed you from the document, we show very similar results, and this would be a way to recreate that. And it's actually quite a flexible model because I didn't put much work into this, but if you put the barrier at 90%, which is not a very common barrier, more sort of aggressive barrier, then you just get to see that some of the outcomes might change. Also, let's say that I increase the auto call level, make it 105%, make it harder to call, then actually I've dramatically changed things. So so I made it harder to call now. So I had 998 before. Now I've only got 667. It's harder to call. And then I go through, you've got different profile. So actually you could do a little bit of playing around just from this spreadsheet example alone. So I'll just put that back to what it should be in that as well. And then if you can remember those results, I'll now flip it to the underlyings 3 and 4, the less favorable ones. So these would actually be real underlyings, and you can hook those up any way you liked. And then we go across here, and it's obviously updated correctly. So only 630 of them call at the second point. We've got many more that are not calling now. We still haven't got any that are losing money, the -1, because those charts were still more or less going up, so it's still quite favorable. But if we make the barrier more aggressive, then here you can see you're losing money. Some of them, so you've got 8% of outcomes you're getting back an average of 0.87, so you're losing some of your return. Okay, so that's all I want to show really on backtesting. What I will say actually is that although backtesting and simulation are quite different and perform different roles, effectively all the simulation is, instead of using real data, you'd use your simulation engine to generate you the equivalent of these numbers, one row at a time, and then do your same calculation and then repeat. So here with backtesting, we repeat by going down real data. You would also go down, but you could generate yourself as many simulations as you wanted because you're just using mathematical ways to create them rather than actual historical data. But it's exactly the same idea. You would need all these values here from a simulation, and then you do the rest of the calculation. So in fact, many banks and firms, effectively their backtesting and simulation engine, they're very related because they do a similar job. Okay, so now I'm going to move on to talk about advisor reporting, having looked at stress testing and backtesting. So advisor reporting is something that I very firmly believe in, and so there's different ways to do that. It can be a whole of market, like I said. It can be by platform. It can be individual firm. So this is for the UK market. We run a live database of all products that are out there. It's currently 32. And so these are made available to financial advisors in an interface they would understand and would be similar to funds. And because this is driven by engines that we have, that as we'd expect, you just need the database of products, and then this can apply to other use cases, different markets. You just set up different databases of products, and then you can show one for one service for one market, one for another market, and that's exactly how platforms kind of work on white labeling and different use cases. So that's very easy to do. Set the products up, do the analysis, and then put them out there. So this is a recent example from the UK market, a real product, and this is this report is the one I showed on the screenshot, motivated very much by how a fund would show a fund report from an independent vendor provider. So you have all the different terms, you've got dates, key features, and then a description and quantitative assessment. So score ratings, risk ratings, and then a couple of charts. And you can see this is similar to the charts that appeared on the stress test report. And then for outcomes, so this one's got a lot of call dates, and we show probabilities simulated and back tested, and then chances of returning of capital, and then another chart. So for the advisor perspective, given the volume of products that they have and the fact that they'll look at other asset classes other than structured products, it's generally more appropriate to show much less information compared to the stress test, which is what this report does. Okay, so let me just call up the second PDF that I have. Right, so this is the same research report that was on the web page, but it's a little easier to see it here. So summary of the different terms of the product, a look at the description, and then the different figures. So this is really how products can be consumed at the advisor level, where products are being created. It's not a pre-issuance test. And also here you see a comparison. This is product that's been looked at, and these are other products that are out in the market. And then the charts and the tables. So enough information to make a decision, but not so much information that it becomes kind of overloading, really. Right, so now I'm going to move on to the portfolio optimizer. So I'll come back to this in a minute. So I'm going to talk about the idea of structured products in portfolio analysis. So this is the application which was brought out by the UK Structured Products Association earlier this year. There's a version actually on their own website, and there's also one that works in conjunction with Structured Edge. So I'm showing this one because of the continuity. And so the idea is that an advisor can analyze how a structured product would affect an original portfolio that they have. So this is something which is starting to become popular in different markets. Switzerland, there's a similar thing. In some of the US markets, the providers in the US market, the various platforms are starting to do this kind of analysis. So this, to me, is the next stage. Like I said before, individual independent analysis or stress testing is important, but then ultimately any product will go into a portfolio. You need to analyze how it might perform there. So this necessarily gets things more complicated, because not only do you need to analyze a product against a portfolio, you also crucially need to know what that portfolio is. So there's going to be certain challenges. You might have an investor with 10 funds, they might have 100 funds, and then if you think of what's an advisor doing, well, they might have 100 investors all with different portfolios, and those portfolios will be sitting on a platform somewhere. And for this to work kind of in scale, you basically need the data of the portfolio, where the portfolios are held in the platform, to be communicated with an application like this one, which is probably the next stage further up. Integration is always key to make something feasible as well as just possible. And if it's feasible and works easily, then it tends to get more widely used. But this is just a flavor of how it can work. So this again was aimed at financial advisors. So the idea was to keep it kind of quite easy to use, and also providing a certain amount of analysis similar to the research report. So as you can see, this application's got 4 steps to it. So the first thing you need to do is to create a product. Now, you can do that by creating a product here. Oops, pardon. And so you'd have a screen, which, as you can see, is like a simplified screen of the stress testing, and then you fill these terms in, and you would get onto another screen, and you would enter some other terms. You can also look at something that you've done before. So here we see one that's already been filled in. So it's got a strike date, 6-year maturity, 7-year autocall amount, and the first autocall is 2 years. So as an advisor, I can set this up quite easily, and the product types have been kept quite simple to define, and they also are the ones relevant to a given market. And then, because this system, we work with the UK SPA and the people that are companies are active in the UK, it's also populated with the same products that I just showed you. So let me pick this one here. This is actually linked to UK and US. And then, so having selected the product, you need to go to the second step. So now you need to select the portfolio. So this is kind of where it gets more complicated. So I'll show one that's already created. And so the idea is here that there's a portfolio with different funds in. So for the database that we have, we've got several hundred funds, but others could be added in more easily. This portfolio could be edited. In fact, you could go and select from the beginning from a whole list. So the idea is you need to somehow get in the funds that an investor has in a portfolio, which, like I said, ultimately, when this whole analysis becomes more mainstream, as I believe it will be in different markets next few years, it's all about hooking up data. Clearly, you don't want to be entering these things in manually. You need to have proper integration. But for this example, I've just got 8 funds, all equally weighted 12.5%. So now we go on to step 3. So we've defined our structured product. We've defined the funds that investor has in the portfolio. And now we come to the crucial part where we're going to allocate a certain amount to the structured product, let's say 10%, which is quite a lot for a big portfolio. It's just purely hypothetical. And so we now have 10%, and you might have seen that these percentages reduce to make way for it, because the idea is that as a theoretical portfolio, if 10% is going to the structured product, something's going to give way. And so in this example, we just reduced it proportionately. It is possible to lock on our system whereby you hold certain allocations of funds you want to keep and reduce others. And other people take a similar approach. But basically, you want a simplified way of seeing what will happen. Then you go to step 4 and do the analysis. So this runs in real time, and hopefully it'll be very quick. And I also have it popped up here, but let's see if it comes back. So what this is doing is performing a live Monte Carlo simulation of the product against the portfolio, and also pulling out all the back testing results as well. And that will give us a quick snapshot of how the structured product might look like compared to the portfolio that has been considered. So you've got 8 funds and a single structured product. Here we go. So this confirms the product that's been used, the Walker Crips UK and US, confirms all your funds that you had in the portfolio, confirms the weightings. And then we've done a historical analysis of the funds. That is basically just a historical time series. For structured products, we had to do some calculations to simulate how that would have worked. And we did something a bit more accurate than the standard back testing. We accounted for different market conditions. And so this is a result which is actually quite common. So we see that the volatility of the modified portfolio, the one that includes the structured product, has gone down. The return has gone down a little bit, but the Sharpe ratio has nudged up from 0.78 to 0.79. Now, it hasn't changed an awful amount, but you have to remember that all we did was put in 10% into the portfolio. The other 90 is the same as it was before, so it's not going to change hugely. And also the structured product was linked to the UK and US markets. The portfolio had exposure to those markets and other markets. So the underlyings, you haven't suddenly replaced equity with property or commodities. So we've only made a small change in the portfolio, and we've used probably similar asset classes. So not going to get a big change, but a reduction in volatility and an improved Sharpe ratio is a very strong story. And it also demonstrates that structured products can go into portfolio. Part of the sort of mysteries of structured products, and why I actually believe this application is great, even if the results don't show exactly what you might expect, is that you put a structured product in portfolio, it doesn't turn it upside down. And in this example, it shows it actually reduces your risk and increases the Sharpe ratio, which is a good thing. And then on the analysis, we have different market events. So we had losses, European debt crisis, and also the first part of the coronavirus shock in the early part of this year, bear market in 2018, and then also positive result in 2016 across the Brexit referendum, which is actually good for equity markets. And then looking at how other tools work again in the fund world, you would expect to want to see what's the potential future evolution. And then now it's also possible to combine back testing and simulations, very much like the stress testing that did, but from a portfolio perspective. What did the original modified do from back testing, and what did they do on a simulated perspective? And that concludes the report. So hopefully this sort of ties everything in together, really. I've shown stress testing, which is issuer and distributor pre-product. You need to do a lot of iterations. You need to set up your pipeline, and you need to do detailed calculations in order to pass-fail. Once a product has actually got to market, then the sort of education needs to go downstream, down to the advisor, even down to the investor, show them metrics that make sense for them. And then finally, the portfolio application is a way to sort of start setting that product into concept of your complete portfolio. Okay, so that's all the material I wanted to cover today. Let me just sort of recap that with a final slide for you. So let's go back to the very beginning. We didn't really cover it in great detail, covered it more in the first part of the training course, bringing products to market. It's a very important process, very demanding, continually evolving. That's what the skill and expertise of all those at the issuing banks and distributors, that's what they're there for, to provide their investor solutions. So structured products have got a rich diversity, many different solutions, different investors, different market cycles. So the product design and the pricing process has been around a long time, obviously, by definition, since the market started. Product testing, regulation compliance has mushroomed in the last 10 years, barely existed really before the financial crisis, which was a kickstarter to a lot of different regulatory regimes. And now it's as much importance as pricing aspects, which is why I presented that chart that had the two alongside. And also for different parties, be they banks or even vendors, you actually align the two things together. So you really have the same system that drives your pricing to some of your product testing. It needs to be done properly, pre-launch, and on a consistent basis, which is why the pipeline is very important. And the pipeline will bring in other parties within institutions, particularly the bank, the compliance desks, and then of course the regulators will want to see that at some point. And also downstream from the issuer, distributor is entitled to ask questions about how the testing has gone, and the distributor has responsibilities down to the advisor and investor. So it's very much a holistic process, getting the right outcomes right across the market. So having done the testing, where's the reporting? So you've got stress testing, the fact sheet, regulatory reporting, and independent analysis, and they should all be done properly and harmonized as much as possible. So consistency, is a good thing. Ease of use and tailored content, particularly down at the advisor level, is also key. So that does conclude this part 2 of this course that I have for you today. So I hope you enjoyed it and found it useful, along with part 1 that we recorded earlier, that go together very nicely, hopefully. So Structured Retail Products, who did a great job this week of hosting the online conferences in, I'm sure we all agree, very challenging circumstances, put out this training course to go alongside those conferences. They will run further training courses and indeed conferences. Hopefully we can go back to physical conferences fairly soon. If you have any questions or want information about those, please contact them on their website. For perhaps more detailed questions about some of the content that I've gone through, any questions you might have, different regulatory regimes, or so how some of the analysis might work, stress testing, back testing, portfolio analysis, please get in touch either to me by email or through our website. So finally, I'd like to conclude by thanking you very much for your time and attention for both these training sessions. So I've covered over an hour in both cases, so quite a lot of content. Thanks for taking time out of your busy days, and hope to catch up with many of you soon. Thank you. Goodbye.